Hi, I'm Doug Goldstein. If you are an American citizen living overseas or planning to live overseas, this program is for you. I originally gave this program as a webinar to professional financial advisors who have clients overseas, hence the title, Strategies You Need to Help Clients Who Retire Overseas Handle a Multi-Currency Lifestyle. But after I gave the program, I realized all of the information here is very, very important for American citizens who live outside the United States. I was also very honored when I was given the opportunity to give this program because I felt it combined three things that I'm actively involved in now. The first one is that I am the author of a book called Rich as a King. I wrote the book with world chess champion Susan Polgar, and it's all about how the strategies of chess can be applied to investing. So I like talking about strategy, and that's what we're going to discuss today. The second thing is that I'm the head of a company called Profile Investment Services. This is a company that's based in Jerusalem, and we deal with people who live outside the United States who want to have U.S. brokerage accounts. And the third thing I do is I teach a number of courses with the Profile CE Institute. CE stands for Continuing Education. All certified financial planners are required to do a certain number of continuing education credits, and we teach those courses at the CE Institute. So I do a lot of teaching. So let's dive right in, and let me tell you what the agenda is for today's discussion. Today we're going to be discussing three things, really. I want to go over the 3 reasons that currency traders get it wrong, and the number one things that clients need to understand about currency. The second thing I'd like to go over is what everybody ought to know about transferring money, and we'll be talking about money changers, banks, trading cash with other people. And the last thing is a topic called the FBAR, and I'll tell you what that means when you find out how the one client I know paid over $1 million in taxes and penalty because they didn't even know what the FBAR was. So let's talk about currency. First of all, you have to define for yourself the difference between your reference currency and your living currency. The reference currency is simply if, let's say I'm your financial advisor and I ask you, tell me what is your net worth? Are you going to say I'm worth $1 million, or I'm worth £1 million, or I'm worth €1 million? Where do you count your money? And the second thing is the living currency. It's a very practical question. When you go to the grocery store, are you paying in Japanese yen, or are you paying in Mexican pesos? That's your living currency. So some people need to trade in currencies, but I wouldn't necessarily call them active traders. The currency market is huge. There are about $4 trillion traded every day in the currency markets, and it's mostly dominated by the institutions. So if you're stepping into that pool, you have to realize that you are literally a pawn against queens. You have very little power, and you are going up against the biggest players out there. The next thing, also a chess analogy I'll give you, is if you've ever played a blitz game of chess, a very fast game of chess against a world champion, it's like a whirlwind. Things go so fast, and before you know it, you've lost. And that's what the level of volatility can feel like when you are trading in currencies. And worse than that, a lot of currency trades are leveraged, which means you might put up $1,000 but be controlling $10,000 worth of a currency, so it makes everything move super fast. And the last warning I want to give you is simply a statistic that almost 1/3 of all retail foreign exchange trades are profitable, which means that over 2/3 of them are not profitable. So the number one thing you need to understand about currency trading is that the currency you trade is the same money that you need to buy food, clothes, and shelter. If it's not, then you can afford to lose it. Maybe you can afford to gamble it. But if you're going to take the money that you actually have to live on, don't start gambling with that money. Okay, so if you are a client, or if you have clients who nonetheless still want to trade currencies, then give them these tips. The first one is you need to keep your trades small, both in dollar terms and in terms of the percent of your portfolio. Don't make huge trades because that just sets you up for huge losses. Next is when you do a trade, set a limit on a position. Decide where you're going in and where you want to go out so that you are not ultimately making the decision based on some emotion that you may feel at the time. Next is you want to avoid the trading programs. I sometimes call them trading problems because people will try to sell you a program they have to make money in currency. And I've got to tell you, I've never seen one where it was so good that people made money all the time and consistently. And I also believe that if someone had the absolute solution to always make money, the golden cow or the golden goose that lays the goose that lays the golden eggs, they would not be selling you this program. I hope it's obvious, but at least diversify. Don't put all your eggs in one basket. And finally, don't just believe you can look at a chart and say, oh, I see there's a trend. I see what happened last week. Well, the market's moving up or the currency's moving up. That's probably going to continue into the future because they tell you that past performance is no guarantee of future returns for a reason. And the reason is because what happened yesterday is not at all a guarantee of what's going to happen tomorrow. Let's move into transferring money. A lot of times, people who are transferring money, they go to money changers. So you can go to a money changer, you can go to a bank, you can simply trade money with your friend. These are all common ways that people move money. So let's talk a little bit about money changers. And there are two main types of transactions that people do. One of them is called cash on the spot, where you literally bring in cash to the money changer, or you give him a check, and then in return he gives you cash. I think that's the lowest risk type of exchange because you don't leave until you have your money. Of course, there is a risk that someone is watching you go in and he's going to mug you on the way out. I can't comment on that, but be careful. The second type of transaction you would do is where you give the money changer money, and he says, okay, tomorrow or the next day or next week, I'll wire the new currency into your bank account. And that has a high risk because that has the credit risk that the money changer will default. Another big issue people have to watch out for in money changers is to realize that they are not investment advisors. Don't let them invest the money. Don't let them say, well, why don't you give us $200,000 and we'll invest most of it. We'll give you a little change now so you can have spending money, and we'll invest it because we've got some great deal. Why would you think they have any better deals than professionally trained and licensed investment advisors? So just stay away from that altogether. By the way, a lot of times I've seen that money changers do give investment advice even though they're not licensed for it. But they feel since they're handling money and since clients feel, well, these guys must be good at money, they must know what they're talking about, doesn't seem to be true at all. Even though the service might be excellent, and that's a real benefit of going to private money changers, is they're competing with good service, safety is a concern compared to a bank where oftentimes the service may not be as good, but I think the safety level is going to be much higher. If you're going to go work with a money changer, make sure that they're licensed. Make sure that they keep the money you give them in a segregated account. Look at their record keeping. And sometimes just the receipts they give you are an indication of whether they're a more quality firm. You know, if they're just writing something on a scrap of paper, I don't consider that particularly impressive. Watch out if they're giving you special deals, really above market interest on deposits, which I don't think they should be holding anyway, or if something sounds so good, too good to be true. As my mother always said, and she was a financial advisor for 17 years, if it sounds too good to be true, it probably is. And of course, make sure that the fees they're charging you are commensurate with the market prices. Next thing we've got to talk about is something called FBAR. Now, before I get into the FBAR, I want to tell you that living overseas has a lot of complications. It's not just, well, now I have to deal in a new country or a new culture. Let me give you an example. Let's say that you move overseas and you decide to retire there, or before you retire, so you work there for a few years and you start to get a pension. Then comes the time you decide to apply for your Social Security. You hit 62 or 65 or 67. And on the form, Social Security asks you, and by the way, every year they might send you a questionnaire to ask you again, are you receiving a foreign pension? And if the answer is yes, then all of a sudden you open yourself up to something called WEP, W-E-P, the Windfall Elimination Provision. Basically, what the Windfall Elimination Provision says is that if you are receiving a foreign pension, or by the way, other pensions, then Social Security might cut the amount that they give you by up to a half. So I was curious about this myself, and I went online to the Social Security Administration, and I found their calculator. It was a little bit complicated to use, but I ran my own numbers, and I discovered that the Social Security payments that I'm supposed to get when I retire are going to be about half of what I had been anticipating, simply because I now live outside the United States, and I'm entitled to get a foreign pension, a non-U.S. pension, and therefore The United States does not want me to get a windfall, not that it's so much money, but they don't want me to get a windfall, and they're going to cut my Social Security. So that's one example. I teach about this, by the way, in a webinar. So if you want to get that webinar, go to the website that's listed right here, www.expatguidetommoney.com. That's actually the website for the book that I wrote called The Expatriate's Guide to Handling Money and Taxes. In that book, we talk a lot about the FBAR, which I'm going to tell you more about in a minute. But also, when you get to that website, you'll see a click where you can go and sign up for it. It's a free webinar to learn about how to calculate how much your Social Security is going to be cut as a result of getting a foreign pension. Okay, the FBAR is the United States feels that any American who has an account outside the United States that at any point during the year is worth over $10,000, he should have to tell the United States about that on the FBAR form, the Foreign Bank Account Report. And if he doesn't, the penalties can be severe. They start at $10,000 and they can move up and they become criminal if you're not careful. The worst case that I personally saw was referred to me by a tax lawyer who was helping a client get taken an amnesty that the IRS was offering, and that client paid over $1 million in taxes and penalties as a result of not having filed an FBAR, which is frankly a bit of an obscure form. Only now people are really becoming to learn more about it. I've been actively teaching about it, and I do talk about it in the book, The Expatriate's Guide to Handling Money and Taxes. So be sure you take a look at that. A great way to avoid the problem of FBAR, not completely, because most people living overseas will at some point have more than $10,000 in an account and have to file an FBAR form. But as far as your investment goes, don't forget that when you live overseas, you don't have to give up on your American brokerage account. There are American brokerage firms that don't want clients who have an overseas address, and they'll make it very clear. They'll send you a letter that says something like, "Dear John, you now have an address overseas. We can no longer maintain your account, or we will no longer give you advice, or we will only take liquidating orders from you on your account." I've seen all of these from people who come into my office and they say, "Doug, what should I do?" My specialty is opening U.S. brokerage accounts for people who live outside the United States. So if, by the way, you're one of these people, feel free to be in touch. At the end, I'll tell you how. But that's a real opportunity for someone to say, hey, if you're not willing to handle my account, I'm not going to move my account overseas. I'm just going to move it to a U.S. brokerage firm, which is happy to deal with people who live overseas. By having a U.S. brokerage account, you continue to benefit from the diversification of having stocks and bonds, mutual funds. Watch out for the catch-22, which I will tell you about in a minute, which is a real problem people have, but I'll give you the solution as well. You can have managed money accounts, REITs, which are real estate investment trusts. You can even have bank CDs, certificates of deposit in an FDIC-insured bank. You can own them through your U.S. brokerage account. Of course, you can have money market funds, treasury bonds, U.S. and global investments too. All of that's available to you through a U.S. brokerage account, just like you're used to. And then, of course, you have all the services that you probably learned to like having a U.S. brokerage account, not the least of which was having your statements in English, having a debit card and checkbooks and online access. It depends on the firm you work with, but I think these are pretty standard. At least this is the standard services that we provide for our clients. Also, because it's a U.S. brokerage account, there are 1099s that are printed and delivered to the IRS, so that brokerage account does not have to be reported on an FBAR. Makes it much easier when your assets are held through your U.S. brokerage account. And in the cases that I've seen, and certainly the accounts that we handle, the U.S. brokerage accounts are protected by the SIPC, which does not mean your stocks and bonds are protected from going down in price, but it protects that brokerage account itself. Okay, so I said I would tell you about the catch-22, which is when you own a mutual fund and you move overseas, sometimes that mutual fund company decides, whoa, we don't want to have clients with an overseas address. So what do? You get kicked out of the fund, or you can't buy the fund, and then you say, well, I'll just go to my local foreign brokerage firm or bank and I'll buy a mutual fund there because I like having mutual funds. That's where you run into a problem. Offshore funds. These are called offshore mutual funds. All the accountants I know don't like their clients having offshore funds because they're very complex to deal with. I wouldn't say they're illegal to have, although a lot of people think that's the case. An offshore mutual fund is usually considered a PFIC, a passive foreign investment company, which creates a much more complex accounting problem that, again, as I mentioned, accountants don't like to deal with. The forms are different. It's a little more, it really is more complicated to deal with. On top of that, the offshore mutual funds I've seen usually have expenses that are higher than their parallel U.S. Mutual funds. And the other myth that people think is they go, oh, well, offshore mutual funds, they've got some magic to them. You know, it's offshore. It sounds mysterious, or it's a hedge fund. These guys, the managers of these funds, are trading in the same markets that everyone else is. They don't have anything different or any magic formula compared to a parallel U.S. fund. The benefit, of course, of having U.S. funds is you've got the increased regulation. But because of that, that's stopped a lot of these companies from handling clients overseas or accepting clients, American clients who live overseas, because of the regulation. The funds just don't want to deal with it. Again, not that it's illegal for them to have the clients. They just don't want to have to deal with it. Sometimes I've seen they'll ask a client living overseas to sign a W-8, which is basically a declaration that you're not a U.S. citizen. But if you are a U.S. citizen, you shouldn't be signing this. So that's a mistake. Another problem I've seen is that people buy a fund, they hold on to it for a while, maybe it went up in value, and then the mutual fund says, wait a second, you have an overseas address, we're busting your trade, we're canceling your original trade, so any profit you might have had, you don't get. So you got to be real careful about buying these funds. So what's the solution? What's the benefit of having a mutual fund? You like the professional management, you like the diversification. A lot of times what people will do is they will use what's called an institutional money manager. You can find a investment advisor who can match you either with mutual funds that accept Americans. That's one solution. Or you can choose exchange-traded funds. Or, if you don't know which ones to choose, you can simply use a money manager. A money manager, an institutional money manager, as the name suggests, normally manages money for institutions. But through a lot of financial advisors, you'll have access to these money managers. And I can tell you this is how we manage a great deal of our client money so that the clients benefit from professional management, they benefit from diversification, much like a mutual fund, but they get they're able to get into it without the problems of mutual funds, American mutual funds kicking them out, and without the problems of having offshore funds, which have the problems we mentioned earlier. So there is a solution to that catch-22. Everything that I've mentioned, I just want to note, has risks involved. This is a discussion of various investments, whether you buy stocks, bonds, mutual funds, even CDs have certain risks involved. Be sure to speak to a qualified, licensed investment advisor before making any decisions. And if you have any problems or any questions, you can, of course, please feel free to contact me. My email is at the bottom, doug@profile-financial.com, or you can just go to our website, www.profile-financial.com. All of these links here are links to some of the books that I've written, and if you are an investment advisor who is a certified financial planner and you'd like to get any of the continuing education credits that are offered by the CE Institute, then go to the third link here, www.ce-institute.com. Thanks so much. Congratulations on making a decision to living overseas. And if you found this useful, please be sure to pass this webinar along to all of your friends who are living overseas or thinking of living overseas, and be sure to send them to www.profile-financial if they have any questions.